General risk disclosure. Trading financial instruments, including forex, futures, equities, commodities, and cryptocurrencies, involves significant risk of loss. Trading is not suitable for all investors, as it may result in the loss of your entire investment. Leverage, volatility, and liquidity risks are inherent in these markets. Before engaging in trading, carefully consider your financial situation, experience level, and risk tolerance. You should only invest money you can afford to lose. Forex and futures disclaimer. Trading in the forex and futures markets is highly speculative and carries a substantial risk of loss. The leverage nature of these instruments amplifies gains and losses, potentially leading to substantial financial exposure. This content complies with CFTC Rule 4.41. CFTC Rule 4.41 disclaimer. Hypothetical or simulated performance results have certain inherent limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. Simulated trading programs are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Equities and commodities disclaimer. Equity and commodity trading involves risks associated with market volatility, company-specific factors, and geopolitical events. While stocks and commodities may have a lower leverage factor compared to forex or futures, they can still result in substantial financial losses. Cryptocurrency disclaimer. Cryptocurrencies are speculative and highly volatile instruments. Trading cryptocurrencies involves additional risks, including regulatory uncertainties, security vulnerabilities, and lack of liquidity. Cryptocurrencies are not regulated by most governments or central banks, and their value may be affected by external factors such as news events and market sentiment. Regulatory references. In the United States, this content adheres to the regulatory standards of the Commodity Futures Trading Commission, National Futures Association, and Securities and Exchange Commission. In the European Union, trading practices comply with the European Securities and Markets Authority standards. Global compliance, content aligns with internationally accepted guidelines, but laws vary by jurisdiction. Consult with a licensed professional in your area. Past performance disclaimer. Past performance is not indicative of future results. Any historical results or performance shown in this content are for informational purposes only and do not guarantee future performance. Educational content disclaimer. The information provided in this video is for educational and informational purposes only. It is not intended as investment advice, nor should it be construed as a recommendation to buy, sell, or hold any financial instrument. Always consult with a licensed financial advisor or regulatory authority in your jurisdiction before engaging in trading activities.
Okay. Second quarter, June, middle of the month. Anchor reassessment. Confirm or revise anchor point status. Take a look. Week 1 took previous month's high. Week 2, OTE. Nice reaction above 50%. Mid-month, the first 2 weeks have been rebalancing, which could have been fun seeking fair value. SpaceX and artificial peace deal should give it a pump. It's a nice midterm storyline as well in this political theater. Adjust the weekly bias template. Option expiry week is usually bearish, so gotta be on the lookout for that. But lately, options expiry week have been running, and it could just to be a fade. The bears play for easy liquidity, which is an easy thing to do because people have been negative emotionally. They're gonna look for the sell. Week 4 I expected to be choppy and to stop out all the people chasing all-time highs again lately. That has been the flow of the monthly cycle. The shifts in framework hit rate, most of it has been execution drift, digging into the 5 whys now and studying executions more. Market conditions have been hard, but it's not nothing I can't adjust to. I had 2 case studies. I don't have none of those. Time frame context review. Did the month deliver the bias I said at the open? So early mid-month, this is what Larry had. Major cycle low window, best buy zone of the year, panic absorption and base behavior, sentiment often worse near opportunity, your focus, reduce aggression early June, look for acceptance and base building, prepare to add now chase. Larry was right about the cycle, so I don't think midterm or summer doldrums. I think ICT was saying he thinks summer could be better this time as well. Start of June, I was expecting higher prices. We got a news failure with good NFP and a major sell-off. That was a sign of a quarterly shift to me. But note that OTE held and Trump is forcing peace and SpaceX. I can see us going higher to finish out the month. The Fed meeting coming up, we'll see how Kevin does his first press conference. I think he will be dovish, just a guess. Expansion and mitigation signals. Which weekly expansions actually built the monthly candle? What did price mitigate? Previous order block, BPR, fair value gap on the monthly or the weekly. This is basically an OTE. So this is like just a 1 minute chart to be a retracement. We could expect higher. The fractal nature of price. Decision quality, high probability versus low probability. This is the focus. The execution. Narrative framework accuracy. Price has been a lot better. I have been seeing the moves before they happen and just been missing out on the execution. That's the key. Experience success plus failure tag. Don't just point and shoot. Be a sniper, not a gunner. Case study vault reference. This is just week one sell off, week two bounce. Start creating like deliveries for the month. See how this month is more of a push up, pause, push up, push up. You better plan out the weekly swings with enough monthly profiles. Hold on. All right. Week three. So, it's the calendar. Central Bank time. Bank of Japan is Monday. I think AUD has bank too. We got it on Wednesday for FOMC. Trump talks Wednesday, 9:30. He's trying to pump us. Philly Fed Thursday, unemployment. Friday is a holiday. And European Central Bank. So Monday is going to be interesting. A lot of central banks this week. Another Wednesday midweek reversal week, just like last week with CPI on Wednesday. Even though we didn't get it on NASDAQ, we got it on SPX SMT. This week is FOMC on Wednesday and Kevin Walsh first press conference. He can definitely give us a pivot up or down. I don't know if I'm spelling his name right. I think it's an L in there. It's the COT. Commercials adding to longs and shorts. Non-commercials taking profits. Feel like they're taking a lot of profits on. They're closing their shorts. And we're bullish. They're closing their shorts. They're not really adding to their longs though. Okay. I used to know how to get it off of here. There we go. Total net positions after trades. Net positions for non-commercials. They're heavily net short minus 194,000. Commercials are net long positive 88,000. Non-reportables are net long, the smart people, positive 100,000. So it's just people like me and you who is bullish and bearish. Commercials are bullish, large specs are bearish, small traders are bullish. All right. The most important group is the commercial. Will repeatedly emphasize that commercials are the smart money because they operate closest to the underlying cash flow and hedging needs. So the current setup is commercials are bullish and large specs are bearish. This is generally a contrarian bullish configuration. Active traders only, removing the spreaders. Williams offers focus on durational commitment rather than spread position. So ignoring the spreads, we got 268 long and 462 short. It remains extremely bearish from the speculative community. So the non-commercials, they're just bearish. These guys are bullish. Commercials added to the longs and added to the shorts. Commercial net position weakened by 23,000 contracts. They became less bearish. That's key. Not an explosive breakout signal yet. consolidation basing. Commercials remain net long, but not aggressively expanding loans. Like they could be waiting for Fed fund rate or something. Price falls while commercials continue accumulating. A strong rally setup develops. If price rises while commercials continue increasing long, breakout odds improve. Mildly bullish consolidation with upside potential. The Wilco, very Wills Wilco concept focuses on identifying unusually strong commercial positioning relative to historical norms. Plus 88,000. This is positive but not extreme. Commercials long, not an historic extreme. No evidence of once in a year setups from this report alone. Commercial strength moderately bullish, not extreme bullish. Commercials, boom, boom. The difference between commercials and large specs, 282,000. Yeah. Immediate bias bullish to neutral. Not screaming buy yet, but the side will be better. Historical record is currently long. Seasonal factors to pair. The highest probability trades. Boom, boom, boom. June often produces choppy. Stronger seasonal typically emerge later in the year. Today, caught a long bullish tilt. Seasonality not the strongest bullish period. Combined interpretation, accumulation rather than aggressive trend following. This makes sense. If commercials continue adding long through summer and specs remain short, that will create a strong setup for a larger durational move. Bottom line. 6 out of 10 commercials on the bullish side, but positions not yet the type of historical extreme. And for NASDAQ, commercials are adding to shorts. They're taking profits on long. These guys are taking profits on shorts and adding to longs. Total net positions. Non-commercials are slightly bearish and commercials are neutral. Small traders are bullish. Unlike the S&P report, commercials have almost no directional commitment. Commercials are standing aside. Active trader on, long. Slightly bearish specs, neutral commercials. What price behavior should be expected? The weekly changes everything, or the weekly changes are revealing. Large specs, previous weeks added longs, cover shorts. Net improvement, positive 11,000. Large specs became significantly less bearish. Then commercials became less bearish as well. Probably Iran stuff maybe. Open interest fell. Okay. So it's gonna be better to trade S&P. Larry Williams, open interest decline, shorts of cover, commercials are not aggressively buying. The market often experience short cover and rallies rather than bull market launches. Range trade the mildly bullish rally, not a high confidence breakout. Seasonality is probably the same. It's not meaningful. Boom. Yeah, it's not really interesting. Open interest falling. So it's a 4 out of 10. Wow. Okay. And NASDAQ's my pair too. By the time that they trade gold, so Fed watches this week, the 17th, 95% chance of no change in rates. Earnings, nothing. No top 10 companies. Sentiment. Ain't when the bears come from. Probably Iran. Bear sentiment has dominated the past 4 weeks, climbing to its highest level in the period, 47.7. Bullish readings have pulled back from the mid-30s range seen in late May, June, early June. Neutral sentiment has also declined. Investors' pessimism is rising, while optimism is fading. Elevated bearish readings above 40% often act as contrarian bullish signal, historically suggesting the market may be oversold and that fear is creating potential buying opportunities. It's good to know. However, sustained high bearishness can also reflect genuine concern weighing on market for individual investors that indicates growth caution among retail participants, a setup that has sometimes preceded market rebounds. Yeah, monitor upcoming market reactions closely. Sentiment can shift quickly. Nasdaq bullish this week. The 40-day IPDA is this range. We got that retracement, and we're at 50% of the 20-day IPDA. After that, it's all-time high. We already got the storyline. And all the charts are basically the same for these three. There's no big major difference. Skill focus, execution and decision quality, high probability versus low probability, journal intent, more life, more intentional, deep journaling, case study hunt, plan, trace location, trade location and time, aggressive, risk options expiry week, Wednesdays, when I'm expecting the anchor point to form. All right, that's it. Got a little bit of coffee left. Y'all have a good day. Peace.